All right, let's dive right into this explainer and untangle the massive economic contradictions that hit the markets on the morning of August 7, 2026. If you were watching the tickers that day, you know exactly what I'm talking about. We had two completely different economic stories unfolding within mere hours of each other, creating this crazy whiplash effect that left a lot of people scratching their heads. So we're going to look directly at the data and the timeline today to see exactly how a soaring tech rally slammed right into a very sobering economic reality check.
The real mystery we need to solve here is how a morning of intense Wall Street optimism clashed so violently with Main Street reality. Usually when we see such dramatic moves in opposite directions like this, it tells us something profound about where the broader economy is heading, and honestly, how investors are placing their bets for the future. So let's piece together exactly what happened, starting before the sun even came up.
Section 1. The pre-market tech rally. Let's look at what was happening before the opening bell. So early that morning, the broader market was essentially holding its breath. The S&P 500 and the Dow were completely muted, basically unchanged, as investors anxiously waited for the July jobs report. But the Nasdaq? Well, it had already had its morning coffee and was blasting off. It was completely ignoring the caution of the broader indices, and this momentum was being driven almost entirely by aggressive pre-market rallies in chip and software stocks.
I mean, just look at the sheer scale of these pre-market gains. They were fueled by massive revenue forecasts. Atlassian didn't just rise. Its shares literally exploded by over 31%, simply because they forecasted quarterly revenue way above what analysts had expected. Cloudflare advanced up to 16.1%, hitting around $330.51, entirely on the back of resilient, AI-driven cloud demand that raised their full-year revenue outlook. And Microchip Technology wasn't left behind either, gaining up to 8.9% on its own strong quarterly guidance.
And this enthusiasm, it spread like wildfire. We saw Palo Alto Networks, ServiceNow, Marvell, and Micron all climbing. The narrative early that morning was crystal clear. Corporate tech, particularly anything touching AI, software, or semiconductors, was an absolute powerhouse operating on its very own optimistic frequency.
Moving on to Section 2. Solar tariffs spark growth. Because, believe it or not, it wasn't just tech booming in the pre-market.
Before we get into the market reaction, we really need to know what polysilicon actually is. Think of it as the fundamental building block of both the modern clean energy and tech supply chains. It's the essential raw material required for manufacturing both solar panels and semiconductors. And that brings us to a major geopolitical catalyst. The White House announced a 15% tariff, along with price floors on products made from Chinese polysilicon. By stepping in with this strategic trade action to support domestic production, they immediately boosted domestic clean energy valuations. The markets reacted in a flash. First Solar surged 6.1% in pre-market action, and SolarEdge gained 1.5%. So before the official trading day even began, the mood for tech and domestic clean energy was exceptionally high.
Part 3. The Jobs Report Shock. Because at exactly 8:30 a.m. Eastern Time, everything changed.
Let's trace this timeline so you can really feel the whiplash investors experienced. You've got the early morning hours dominated by these thrilling tech earnings. Then, news breaks about tariffs boosting domestic solar. It feels like a morning characterized entirely by growth and strategic market wins. And then, the clock strikes 8:30 a.m. The Bureau of Labor Statistics releases the July employment summary, and the narrative flips entirely on its head.
Here is the staggering number that dropped: negative 23,000. The U.S. economy unexpectedly lost 23,000 non-farm payroll jobs in July. We're not talking about a slowing of growth here, not a modest gain. This was an outright contraction. To really understand the magnitude of this shock, we have to look at the gap between expectation and reality. The consensus estimate among economists was that we'd see a healthy 80,000 to 88,000 job gain. Instead, we got the harsh reality of a 23,000 job loss. It was a massive miss that completely shattered Wall Street's expectations for a stable labor market.
Section 4. Digging into labor losses. Let's look a little deeper, because that surface-level number was just the beginning.
So when new data is released, previous months get updated too. And actually, those updates were brutal. Job numbers for May and June were revised down by a combined 103,000 jobs. These severe revisions mean the trailing 12-month average of job creation collapsed to a mere 34,000 jobs a month. The labor market wasn't just struggling in July, it had secretly been cooling off much faster than anyone realized.
There was also a stark, honestly kind of scary contrast hidden right there in the sector data. Healthcare was the lone bright spot, adding 22,600 jobs. But outside of that, Everyday businesses were slamming on the brakes. Leisure and hospitality lost 40,000 jobs. Retail lost 19,000 jobs. These are consumer-facing industries, and these numbers are a flashing warning sign that local businesses were actively cutting staff.
Then we have 61.4%. That represents the labor force participation rate. In July, it plummeted down to a dismal 5-year low. This measures the percentage of the working-age population that's either employed or actively looking for work. When it drops this low, it signals some deep structural discouragement happening in the workforce.
Now, if you just skimmed the headlines that morning, you might have thought things actually improved because official unemployment fell slightly to 4.1%. But it was basically a statistical magic trick. The only reason unemployment officially went down was because 264,000 people abandoned the labor force entirely. Since they stopped looking for work, they were no longer counted as officially unemployed. It's an illusion that masks some very real economic pain.
Which brings us to our final section, Fed policy market implications. How did Wall Street digest this? Well, it created the ultimate bad news is good news paradox. With the weak jobs data, U.S. Treasury yields dropped right away, falling 4 to 6 basis points. But instead of panicking over the job losses, stock indexes surprisingly rose in early trading. The S&P went up 0.33%, the Nasdaq climbed 0.86%, and the Dow bumped up 0.09%. Why on earth would that happen? Because the struggling labor market actually triggers a very specific response from investors.
Investors immediately started betting that this labor market shock would absolutely force the Federal Reserve's hand. Wall Street took the bad economic data as a guarantee that the Fed would have to step in and provide relief. Futures markets instantly priced in a 60% probability of a Fed pause in interest rates for September and a 45% probability for October. They bet the days of the Fed tightening the economy were over. And for everyday people, a Fed pause could eventually mean cheaper mortgages and auto loans, which is exactly why Wall Street started seeing green despite the grim jobs report.
So as we wrap up this explainer, I want to leave you with this final thought to ponder about the long-term impact of today's extreme market whiplash. We saw incredible corporate resilience in tech and strategic domestic policy wins in clean energy. But we also saw a Main Street economy rapidly shedding jobs and workers giving up on the labor market entirely. If the market is relying on bad news to force the Fed to pause or cut rates, we really have to ask, is the Federal Reserve already reacting too late? Thanks for joining me for this breakdown, and keep your eyes on the data.